It is now my pleasure to introduce Steve Orr to you. Steve is the Managing Director and Chief Investment Officer at Texas Capital Bank. He has a wealth of knowledge and is going to set the economic horizon for us. You are in for a treat. Welcome to the stage, Steve.
You think with all the effort they put in, they could put some hair on that picture. Golly. All right, let's see if this thing works. All right. Good morning. Who needs coffee still? It's okay. Go ahead and admit it. Come on, hands up. Who needs coffee? All right, here we go. For those of you who need coffee, get out your pencils. Here's the summary. Economic outlook. 2.6%. Texas, 3.6%. Inflation, 3 going to 4. Markets, 4, 5, 7. Commodities, up 6%. Okay, we're done. So, for those of you who don't need coffee, let's take a look at where we've been. 23, we were hitting 3% in the recovery. Recovery's done. 24, we backed off a little bit, 2.6-ish, 2.5. These are real numbers. College Station algebra, real 2.5 plus 2.5 inflation gives you a nominal growth of 5. 5 is your floor. Below 5, you're starting to get into recession territory. You need to look closely at this graph. I'm not incapable here, but I'm gonna laser over here on this side for this crowd. You see +5, -3. Okay, do you think it should be like -2, +2? No, it's +5 because if you have 5% real growth plus 3% inflation, that's 8% nominal. You're going to double in 10 years. Does anybody want double the traffic we have on 35 now? No. Okay, -3 over on the other side. -3 plus 3% inflation is 0 growth. That's stagflation. Okay? 1932, depths of the Great Depression. What was GDP growth that year? 28% unemployment, at least that was the count. It was actually probably much higher. We had breadlines, no hope, et cetera, Dust Bowl. What was the GDP growth? Over, under. Come on, somebody. Come on. Those of you who had coffee. Anyone? -6. -6. Okay. -6 that year. March, April, May 2020. What was GDP growth? Annualized. Over, under. -15. Look around. You're all here. It's okay. We'll get through it. 5 years ago, next month, aliens descended in a paranormal event to Earth and shut down our economy. Never happened before, ever. Okay, you have an abnormal rebound, thanks to a lot of different things, but people going back to work, and then you have this strangely weird situation here. We should have had a recession in 2022. Just a normal up and down movement. We should have had a recession and we should be climbing out of one right now. But we didn't. And we didn't. We're going to talk about that in just a second. First, let's jump into the components of the economy. Just the good old C plus G plus I. Just real quick, consumption, government, investment. Core retail sales are doing just fine. Consumers are running about a 3% run right now. Remember, that's 68% of the economy is consumer spending. The top half of the consumers are responsible for about 70% of all spending. The upper half of consumers are doing okay, doing just fine. 3% growth is perfectly normal. So we're back there. Here's your home economist package. I'm going to give you 2 slides today where you, without staying at a Holiday Inn, can be your own economist for free. And all the data I'm going to give you is free also. This is a really ugly looking chart, but the pink bars, the vertical bars are recessions, okay? Now, that that beautiful burnt orange line, yeah, I know. It does pain me to have to go to Texas A&M Research Center to get my real estate data. I get that. As a Longhorn, it makes my finger twitch every time I click on the website. But I still get that beautiful burnt orange line up there. That's consumer credit. Notice it's pretty volatile. But look at all these other little squiggly lines down there, and see the horizontal line? That's 2%. Not zero, it's 2%. And what you're looking at here is real sales to domestic purchasers, consumer credit, and retail spending, retail sales. Okay, all these are free on the St. Louis Fed website, Federal Reserve website. You can make your own account, and as long as they stay above 2, there's no recession. And if you look here, right now, everything's well above 2, 2.5, 3, we're okay, we're fine. Now you notice that consumer credit has taken a dive here, and it usually dives about 12, 18 months before a recession. And let's just skip the bad news, come over here. So why is that happening? Well, the bottom end consumer is getting stretched right now. All of this fun stimulus that we had, and my mother got some of this stuff. This was all that spending, these various post-shutdown acts from Congress gone wild, deficit spending, 6.5% of GDP. Never before since World War II, not even in the Civil War, did we spend that level of deficit spending. It can't continue, and that's why long-term interest rates are rising. They're not rising because they think Trump's going to spend more than Biden. That's almost impossible. But they're rising because there's so much money sloshing around. And I'm going to get to that here in a minute with the really bad news. But the consumer at the bottom end is stretched right now. And you see delinquencies are rising. And on the banking side, we see consumer loans also, delinquencies are rising a bit. Now, they're not in danger territory yet, but it's something to watch. Finally, industrial production is bottomed and starting to turn higher. And all these stats we're talking about, those are backward looking, right? Jobless claims every Thursday, the unemployment report the first Friday of the month, consumer price index, all those are backward looking. What happened last month? What happened 6 months ago? But ISM, Purchasing Managers Indices, these are surveys looking forward, and they're telling you new orders are turning up. Industrial production is starting to turn up, and we think we're at the beginning of a very nice industrial cycle. So consumption, okay, 3%. Government spending coming down, 1.5% growth there. Industrial side, 3% growth. So all that's adding up to a very nice 2.5% growth here the first 6 months. We think the second half of the year is a little bit of a slowdown. So I just gave you the summary. You don't need to see this now. So we'll just move along. So what about things that could happen? Over on my world, events throw markets off temporarily. They rattle things like Monday with the DeepSeek thing on NVIDIA and a few other of the big Mag 7. But long term, global trends affect the economy. And the first thing you need to always remember is we are at the end of a 70-year global trade cycle. Now, throughout history, global trade cycles are about 50 years. This one's a little longer, courtesy of your tax dollars that paid for our Navy to keep the sea lanes open. Anybody know how we got a Navy? Come on, extra cup of coffee on me. Why did we get a Navy? We're a mercantilist country. We keep the sea lanes open for our trade. All right? Halls of Montezuma, Marine Corps hymn, the Barbary pirates, those are the Islamic radicals of the day from Tunisia, impressing our sailors and robbing our ships. That's how we got the Navy. So we just kept that process up for 200 years to everybody else's benefit. South Korea invaded thousands of times over the years. They stick out like a sore thumb in the Yellow Sea. Hey, how did they dominate in consumer electronics and small cars that crash very easy? It's very simple. Our Navy. Same thing with Taiwan. So, we've benefited the world, and that global trade that started with Bretton Woods after World War II is coming to an end. Like global trade cycles always do, so there's a lot of reshoring that's coming. The Loper-Bright decision is going to be huge for deregulation and for smoothing the application process. Does that mean you still have to do a phase one on your dirt? Yeah, you're still going to have to do a phase one, but maybe there's some permitting stuff that'll go a little smoother down the road, and you may not have as much court time, which would be great. So anybody name the 4 wars? Anybody? What's number 1? I heard Ukraine. Ukraine's moved up to number 2 now. What's number 1? Number 3. What's number 1? Cyber. Okay, so we're a bank. We get attacked 2,000 to 3,000 times on average per second. On a busy day, it's about 10,000 attacks a second. Those are mostly state actors like Dancing Bear in Moscow, Yellowstone in North Korea, all of these different hacker groups. Remember, North Korea has funded the Taepodong series of intercontinental ballistic missiles by hacking. 17 school districts in the Metroplex were held for ransom last year, including Rockwall, where I live. And so, this is a real thing. So cyber, Ukraine, because of Russia now attacking Finland, cutting the fiber cables, preparing the battle space, pushing the immigrants into Poland. So they're preparing to expand that war, even though they're running out of people. Now that North Korea is supplying them with troops, it's not so bad. Israel, Iran, of course, and then finally China, Taiwan is gearing up. So there's your 4. Can anybody name the 3 that are on deck? Azerbaijan, Middle Africa with the Islamists, and finally Sudan's about to break open again. So sticky inflation. Inflation comes in waves. We're going to talk about that a little bit more. Please, when you plan, don't be like the Fed. We're not getting 2%, okay? It doesn't exist. That's a New Zealand economist who will remain nameless. I've got a little voodoo doll at home I stick pins in. But it's 4. Please plan on 4% inflation, okay? If it comes out at 3.5, you're a hero, all right? All right, let's have some fun. Texas, we're just coming back up to long-term trends in industrial production and services. Very nice. Housing, of course, still remains an issue everywhere. You can see the bottom line doesn't look so good. Doesn't look so good there. But, we've at least come back up a little bit on mortgages and, permits. I mean, at least stuff's happening. Now, this is not a bank opinion. This is a Steve opinion. If you show up on I-40 or I-10 in El Paso and you have more than 2 suitcases, in my mind, you go to Big Bend or Dalhart. You can't come to the Texas Triangle. We're full. It's just my opinion. Since I sit on 30 every day. So Texas is best. We at the bank say, if you cannot make it here, we're sorry. We don't think you can make it anywhere. It's the best business conditions. We're growing 1% faster than the rest of the country, 3.5%. We have a young, educated workforce. Most of them are good looking, better looking than me. There's a huge education system up and down 35, as y'all know. So we've got a younger than average workforce than the rest of the nation. Energy is 20%. Healthcare is 19%. Finance and insurance is about 17%. It's a very diverse economy now. Okay, now for the bad news. So that was happy. This is sad. This is the monthly noise that you hear on CNBC. The up, down, up, down, up, down. Most of it's the green bars at the bottom, energy prices. That's just noise. What's more important for you is what is the source of inflation? Now, back after GFC, they said, it's government spending. Government spending in and of itself does not cause inflation. It's a convenient scapegoat, but please think of inflation like a swimming pool. Over on one end, there's a guy with a bucket scooping water out. That's taxes. Scoops out $1 of taxes, runs around to the other end of the pool, and pours 60 cents in. So overall, the price level doesn't change very much. The Fed creates dollars, and banks and private credit create more credit in the economy to raise the pool back up to the $1 level. Does that make sense? So overall, the price level stays fairly flat. Remember, the 1912 Federal Reserve Act, that was the charge of the Fed. Stable money, stable dollar. Congress came along later. Anybody remember the base closing acts? Got a little bit of real estate trade out of that one in the early 80s. Whenever Congress doesn't want to assume responsibility for something, they either create an agency or foist it off on somebody else. And so they told the Fed under Humphrey Hawkins in 77, hey, look, you guys you're responsible for full employment too. Do you know how much a Federal Reserve economist knows about full employment? It's the null set. I just guarantee you right now. The nice people, they're really smart, but they're not supposed to know anything about creating jobs because they're economists. I mean, we just sit around and build models all day, play with numbers. So what the point of this chart is, yes, the pink bars are recessions. The amount of checking and savings floating around in the economy determines inflation. So when somebody backs a truck up to the swimming pool and pours a whole bunch more water into it, and there's no more economic activity, there's no change in demand, the level of the prices goes up. Does that make sense? And that's exactly what you see here is if you take the time to look at this chart because you have nothing better in life to do, the change in money supply leads inflation by about 6 months. And when the change in money supply drops drastically, you get a recession. And right now, as you can see on the far right side, the money supply has gone down, it's hooked back up, it's coming up, and this foots with, I'll come back to that one to really get some nasty remarks. That foots with every inflation wave going back to World War I. So my guy Ethan in the shop went back for me and looked at every CPI spike, Consumer Price Index spike, going back to World War I. And what do you see? Every time in the 35, 40 months after the first wave, you get a secondary spike. And so we bottomed last summer, that big, thick black line, and we're already starting to crawl back up. You need to plan on inflation this year sitting at 3, finishing the year north of 3, and headed towards 4 over the next couple of years. Please do that. Now, just go back one slide. This is just I don't know what to do about this, but when this is 2%, the magic dotted line that the New Zealand economists pushed on people years ago. And so Wall Street, all these little wispies, these are Wall Street forecasts. And so when inflation's high, they all forecast it's coming down to 2. When it's disinflationary, inflation's falling, oh, it's going to come up to 2. And they're still forecasting it's going to come to 2%. I'm telling you, it's not. It never has. We're in a wave, a 15-year wave that's just starting. It's going to crest at about 5 to 6%, mostly driven by demographics and money supply. And just plan on it. Oh, no, that's an ugly chart. I don't want to show that. Okay, so summarize, 3 headed to 4. There's a new cycle started. There's just too much money in circulation right now. Okay, this is the second slide for you. Now, you're going to get all these slides later. Remember, it's free. I mean, what's it really worth? But this is your handy little chart. So check it off. Is single unit housing dropping? No, it's going up. Non-defense capital goods, ex-aircraft, again, that's another series on Fred. Is it dropping? No, it's choppy, but each low is higher than the previous low, so the trend's up. Consumer expectations, did we have a 10-point decline? About a year and a half ago, yeah. When mortgage rates started rising because the Fed was jacking rates, which they didn't need to do, and they didn't need to cut either, by the way, sorry. Weekly jobless claims, are they rising? No, they're still low. ISM, new orders? Oh, no, they're comfortably in expansion territory at 50. Anything above 50 is expanding. And what about 2-year Treasury versus the 10-year Treasury? Well, it was inverted for a while, and now the curve's re-steepened. So if you're in the mortgage REIT business, you're very happy today because it's much easier to fund your mortgage positions. And finally, lower-rated corporate bonds, those spreads are very tight. So borrowing conditions right now, come see us, is very good. Make sense? Okay. So there's your handy chart. So we're nowhere near a recession. So ignore all the noise on the hairspray channels. We're fine. And if you just replicate this chart yourself and look at it at the end of the year, kind of like you look at your 401k once a year, you'll be fine. So I didn't even need to be up here. This is great. So jumping along here, what's one other tell? Going back to that table, look at the unemployment rate versus a 3-year rolling average. And we're just hooking up, and you can see the pink bars are recession. And so are things going to slow down later this year, probably into next year? Yes. Are we going into a recession? Probably not too fast. And why? Think about yourselves. Think about the mortgage industry in particular. Think about housing. They've already been in a 2-year recession, right? Yes? Hello? Yes? Industrial production, 18 months. And usually the unemployment rate starts to rise after a recession starts. Okay, we've gone from 3.5 to 4.2. Statistically, that's just not that much. Now, there's this SOM rule thing and yada, 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 and there's all sorts of things that economists come up with. It really doesn't matter. They're just not having the effect that they used to because things are different now because we're in a new inflation cycle. So we don't think that there's a recession on the horizon. We don't worry about a slowdown until the end of this year into next year. All right. Now, just in case you weren't fully awake yet, I just want to dramatize how fast the debt's grown and why government spending has to slow. Now, the black line going down is the value of $1 from the time the Federal Reserve was created. The red line going up is our amount of our federal debt. And what you can see here is we had a big jump after the financial crisis in 2009. We had a huge jump here in all those blue bars from the Inflation Reduction Act and the Recovery Act and all these different things that the prior administration and Congress gone wild dumped in people's pockets. Now remember, my mother got money. I got Christmas presents. The last 2 years, I haven't gotten Christmas presents in years. So, kind of had a knock-on effect for me, and clearly it stimulated the economy because, it's an okay tie. I mean, she's got pretty good taste. But this jump here, now in my world, we call this a parabolic curve that always has to reverse. There's not any way to knock down the debt anytime soon unless you have a jubilee, and I don't think the modern era people from 4,000 years ago understand what a jubilee is, so we're not going to have that anytime soon. But my point in this real chart here is for you to look in your wallet and to know that 1 out of every $5 in your wallet has been born in the last 2 years. That's inflation. Aggregate demand really hasn't risen to offset that amount of dollar increase. Did that sound like an economist? That guy cool? Yeah, I'm not an economist. Anyway, here's the dramatic rise. So you can see it took us 232 years to get just to 10 trillion. To get to 32 trillion, it took 8 months after the 31, and on and on and on. And now the outgoing administration, when the new fiscal year started October 1st, has spent over $800 billion already. And so you think about it, we're not halfway through the fiscal year that ends September 30th, but yet we've already spent almost 40% of the available budget. And we've already hit the debt ceiling on January 1st, so we can't borrow anymore until Congress pitches their little fit and says, I want more allowance, and then they go and raise their allowance, right? I mean, the debt ceiling is totally unnecessary. It's probably unconstitutional, but that's not going to happen until May or June. So from a borrowing perspective for your deals, rates are going to be pretty level for the next few months because there's this cap on more Treasury issuance. But once that cap comes off, we're going to need to fund, probably a good 3.5%, 4% deficit. Fortunately, it's not going to be 6.5%, but there's going to be a lot more Treasury supply later this year, so long rates are going to tick back up some. So just be ready. Okay, anybody want to talk about stock market? Nobody really cares, do you? We can skip this part. Okay, real quickly. We are still in a secular bull for stocks. Secular bulls last 15 to 18 years, depending. A secular bear, 1.5, 2 years, much sharper. Inside of secular bulls, you usually have 3 up cycles, 2 bear cycles. Make sense? The current bull cycle started with the Oct 22 low. We're up in this cycle about 71% as of yesterday. So that's that black line down there, this black line right here. And so what does that show you? This is kind of just an average bull cycle. Nothing really great exciting. Now, the hairspray people on TV, what are they screaming about? Oh, it's a very narrow market. It's just the Magnificent Seven. Hey, newsflash, folks. That's the way every bull is. Every bull has very narrow leadership. Roughly half the stocks that have ever been issued don't do squat. In fact, most of them are, the family selling out. It's a tax dodge. Sorry. So look at the New York Stock Exchange Composite. Look at the S&P 500. Don't need to look at it that often. But this is just an average bull cycle so far. And what you see when you go back to World War I, just after World War I, and you take all the years in this part of the cycle, all the years ending in 5, because they do repeat, all the years in this part of the bull, and you stack them on top of each other, you get this kind of blue average that you see here. So you kind of muck around the first few months. You get through the summer, you rally in the summer a little bit, and then you usually have a drawdown or you go flat in September. Remember, September's the worst month of the year, not October. I know there's a few of you who were alive in October of '87, and you think October's the worst month. It's actually Sep. So also, remember, we're in the first year of a new administration. And first year of new administration, which is way behind. For instance, Obama had 12 appointees confirmed first 5 days. I think Reagan had 7. Trump's had 2. So the new administration's taking, it's faster than Trump 1.0, but it's pretty slow. So there's some mucking around usually, and then things kind of get going later on in the year. That just fits perfectly with the tax bill. What's the greatest problem your clients or the occupants, your business occupants of your real estate have? They don't know if those 2017 taxes are going to be re-upped or not. And they don't think Johnson and the House are moving very fast. So now James and I could probably argue about this a little bit. We argue about everything. But the point is, that shows up in the chart already, doesn't it? That if you get this bill passed and it comes through the Senate and it gets signed in the middle of the year, that's when you get the rally. That's exactly what that blue line in the gray box is showing you has happened in the past and will probably happen again. Hello? Okay. Let's see, where am I? Come on, come back. One more. Golly. Okay, finally. So what about long-term rates? So this is the 10-year, going back quite a ways. Yes, I remember the big spike coming down Volcker, but the point here is if you take this 10-year Treasury and you run it back to the Civil War, which we have good data back to the Civil War. We don't have quite as good data. We have to use the 5-year, and we have to use some other like Alabama, Georgia type cotton bonds before the Civil War. But we can run this back to the 1790s. America is very consistent with long-term rates in 40-year up cycles and 40-year down cycles. We just finished back in 2020 when we bottomed at 52 basis points, a little bit of a 0.5% on 10 years, the end of a 40-year bull interest rate cycle. Are we going back to the teens at the end of this 40-year cycle when most of you will be retiring and I'll be, my estate plan would have matured? No. 7%, 8%? Yeah, that's reasonable. Very reasonable. Whole lot of demographic forces pushing that up. I took the demographic slides out, not because I only have 20 minutes to talk, but because we want to keep this light and keep y'all excited. But birth rates are a real problem. Everywhere above the 30th parallel around the world. Doesn't matter. Choose your country. And the good kind of inflation, the good kind of economic growth is when families are being created throughout history. So finally, this time is different. What's different about this time? Fed's starting to cut rates. Usually when the Fed cuts, they're doing so because the car's already careening off the highway. Remember, TL, TF squared. That's write that down, TL, TF, that's my trademark. The Fed's always too late, they always go too far, and they always go too fast. They're very reactionary. They're late. Again, they never cut a 0.5% unless they panic. So why on September 18th did they cut a half? Purely political. They're worried about global liquidity, global politics. They're worried about the new administration and the spending. Their cover was, well, we're not going to fight inflation anymore. We think it's on a good downward path. We're worried about jobs now. Okay, that was September. Yesterday, oh, we're not so worried about jobs, but if unemployment ticks up, we can cut again. And inflation stopped coming down. They finally admitted it. So they're in search of a narrative. They're in search of a reason. They would like to cut another full percent for a variety of reasons, mainly to have the flexibility to raise again if the economy does better than they anticipate. But you need to know cash is 4%. Cash isn't coming down anytime soon. And you can see in this graph, 10 years ticking up. Only happened one time. Only one time since World War II when the Feds cut and interest rates rose. It's because of deficit spending, and here we are again, too much deficit spending by Congress, okay? So rates are ticking up, even though Fed's cutting. Now, when does it stop? Again, we've got this kind of ceiling right now around 5% on 10s because we're not issuing any new debt. But when the gloves come off later and Congress gives itself a pat on the back and avoids a shutdown for the... Anybody know how many shutdown threats we've had since they started this? We're at 96. 96 shutdown threats. Does anybody really care? Come on. It's just Congress trying to get attention. I mean, these are the same kids, remember in elementary school in tetherball? These are the kids that you hit with the tetherball. And they go to D.C., and now they make the rest of us, have a tough time of it. They're taking out their revenge on us. So, long-term bull, several years left. Cash is 4. Bonds with a credit spread, probably about 5% this year. Stocks, 6 to 7%. 4, 5, 7. Cash, 4%. Remember, inflation's 2.5, 3. You're actually building 1% real wealth right now. So my mother-in-law, who only has CDs, God bless her, farmers, I might even get a Christmas gift from her this year because she's earning interest on her CDs above inflation for once. So 4% cash this year. Plan on about 5% from long-term bonds. Look for stocks to really return about 6 to 7. And when you have a bull cycle where the first 2 years, remember October 22, your first 2 years are 20% plus. We have 9 cases where that's happened. Year 3 is always just low single digits, so 4 to 5. Earnings growth, margins are at records. S&P's 12.5% margins. Earnings growth is coming out pretty good right now at around 12% year-over-year growth. Wall Street thinks earnings are going to grow 15% this year. That assumes a lot of deregulation that's not happening yet. That assumes pretty mild tariffs, which aren't on, February 1, I realize, is first round for tariffs, and don't really think that's going to happen, but we can talk about that later. But look for long rates to stay right about where they are. Stocks are going to be mid-single digit returns. Okay, commodities. Everybody here has inputs, whether it's dirt, nat gas, whatever. Now, I have an oil graph up there because it's more fun to talk about crude oil, but the fact is you got to have incentive to drill for crude if you want more nat gas. We're running at 5-year lows in average storage for natural gas here. Europe's in a much worse place because somebody, I don't know who, and we're not going to do the conspiracy thing, blew up the Nord Stream pipeline. Somebody in Ukraine turned off the pipe from Gazprom. So they're, at the margin, they've lost about 10% of their supply. So they're in a world of hurt, but it's okay because, what's happening in Europe anyway? I mean, they're committing suicide, that. Long-term economically, it's a whole other, I could talk for an hour just about that. I'm not going to. But what you need to know, nat gas demand is going up with LNG exports, with peaker power supplies, with the data centers. All that is going to drive demand. I mean, we're talking about electricity demand growing at 3%. Now, some of you who aren't familiar with the electricity market think 3%, that's nothing. But yes, it is when you consider the last 15 years of grid growth or demand growth has been about less than 1% on average. Why is that? LEDs, fluorescence, lower power TVs, all that stuff's reduced demand in the aggregate. It's been a wonderful savings for us. It's given us a little bit of breathing room. But the problem is when you run a training chip on a machine learning server that consumes 800 watts idle, 900 to 1200 watts full peak, you're stressing the transformer out on the power line way multiple times more than just running some light bulbs. And there's, 40 million power transformers just in the 5-state area here that need to be replaced? I mean, we need to spend some money on the grid fast. So commodities, think commodities 6 to 7% growth this year. So if you're planning on building something or you're working with your subs, 4% inflation, commodities, inputs, concrete, all that kind of stuff, put a 6% inflator in there, okay? So consuming countries, mostly no growth. That's above the 30th parallel. The digging countries, pretty good shape. China was the big buyer for the last 40 years. Now it's all the rest of us. So finally, we think 2025, 2.6%. There's a lot of bias and headwinds that could slow us down later in the year, but we think there's room for upside surprise. We think the tailwinds are going to overwhelm the headwinds. Texas leads. If you can't make it here, you can't make it anywhere. It's kind of the inverse of Frank Sinatra. Inflation, 3.5, but plan on 4. Interest rates long-term are headed higher, and we're still in a bull. So I have a couple of minutes for questions. Good, no questions. All right. No, seriously.